The corporate sector in Sri Lanka continues on a high as company after company turns out significant profits post-war. But the cost of corruption and tax evasion also continue to tower over the nation's achievements and prospects in this new era of hope. I spoke to Suren Rajakaria, partner, KPMG Ford Roads Thornton and Company, to find out if there's a remedy in sight. Suren, thank you so much for accepting our invitation to be on the show. Welcome to Benchmark. Now, corporate governance is one of those phrases that's bandied about quite a lot these days. In a nutshell, what are the issues of the day as far as corporate governance goes?
The term corporate governance itself is a good thing. I mean, there are lots of good things happening in the country, but in a nutshell, if we were looking at the issues per se, the process which is adopted in Sri Lanka needs improvement. It's generally like a tick-in-the-box kind of approach because people just want to conform to the rules. The general approach should be to sort of try and comply with the rules, but see in spirit that they actually achieve the purpose of governance. So the issues commonly cited are conflict of interest in Sri Lanka, related party transactions, significant shareholders trying to dominate the activities of a company, CEO dominating the board of directors, audit committee generally comply with the rules set out in Sri Lanka, but I don't feel that they actually achieve the purpose of setting up an audit committee. So what I mean by that is they generally go with the flow. If the chairman says something, if the CEO says something of the company, they just go with that flow rather than really challenging and achieving a purpose.
So what you're saying is that there is compliance, but the compliance is basically on a tick-in-the-box basis.
Unfortunately, currently, it's a tick-in-the-box kind of approach. So we have 10 rules. Okay, have we ticked all 10 rules? Did it actually achieve a purpose in terms of governance? Significantly, no. I mean, there are few very good companies which do actually try to conform with the rules, and also it's reflected in the performance of those companies. But generally, the answer would be yes, it is kind of a lip service to governance.
So looking at corporate governance, how are our companies faring these days? What are the new methodologies that are emerging and from where?
In terms of methodology emerging for governance aspects, I mean, it's more principles based. So the problem with having principles based governance rules, or for that matter any other standards, is it relies too much on the persons trying to manage that. There was this common phrase in the US when the Enron and all these other collapses happened. They said for principles-based standards, you need principled people. So that becomes an issue. So emerging rules, I mean, in the UK, they say, okay, comply or explain. So they have principle-based rules. These are the good governance principles which a company should use. But I mean, it's not the same for every other company. The rules cannot be standardized. So if some companies do not comply, they explain as to why they haven't. Significant one would be if chairman and CEO are not different people and the same persons, they are able to explain.
So do we have it in our culture where investors and stakeholders actually question the powers that be?
We find it at AGMs, but that's just for the sake of asking a few questions people come and ask. But investor activism is very good. I mean, we find it, there are good examples in the UK, even in India there were some examples in relation to Tata some time back. But in Sri Lanka, answer is unfortunately no. We need probably an investor code or a charter or something which should be introduced by one of the big regulators, maybe the SEC, where they can insist that investors also play an active part. But still there could be a little bit of involvement where especially funds, investors, funds, corporates who do this as a special activity would bring in some special focus on governance principles, and they can ensure that the companies they are investing in are also governed properly. Govern meaning some people just interpret it for management, managing a company. It's not really that. I mean, is your business sustainable into the future? People don't look at it, because if you appoint a director for 3 years or 5 years, that guy is interested in looking at his period only. Whereas the corporate sustainability expands to a wider period than his own or her own period. That's the issue. So I think investor activism could be better.
Suren, one of the issues that is most often a white elephant in the room is bribery and corruption. Is it that companies just think it's a necessary evil and would rather not face it but just go along with it? Or are companies actually taking note of it these days?
A lot of people say we are a, what is that? We are a some-star economy trying 7-star rules. A lot of these business people, senior people try to give that as an excuse. This has happened in our profession also. When we tried to introduce better accounting standards, they said 7-star rules for whatever star economy. That's not correct, because we need to strive to become better. We need to govern our companies better. Okay, there are, like say, issues in terms of corruption and bribery. There are ways you can manage them. Some of the companies' corporate code says we will not do corporate political donations or we will not get involved in bribery. So whether they comply with the charter is one aspect of it, but when you have those rules in your code of conduct and your charter, you tend to slightly at least see whether we could comply with it to an extent. I mean, if we still said we don't need the 7-star or whatever number of star accounting standards, we would have been still reporting like 100 years ago, and we would have seen an Asian financial crisis in Sri Lanka.
We take a quick break now for some messages from our sponsors, and when we return, we look at audit committees, issues that stakeholders should be aware of, and the inability to fully comprehend annual reports. Stay tuned. Thank you for staying with us. You're watching the Big Picture Business Program, and we continue with more views and insights from Suren Rajakaria. So within this corporate governance structure, audit committees in listed companies, do they actually improve corporate governance in the long term?
My comment would be they tend to do a little bit of improvement, because you have something called an audit committee, because there is terms of reference, because there is a charter that they have to comply with. They try to do it. Only negative aspect is it's kind of a tick in the box activity. So you have audit committees, we should do 10 things. We should have a charter, we should have policies, we should have internal audit, we should have, so they tick off all that. But in addition to that, they need to perform that governance activity, which is where I find it inadequate. Because what I find is financial expertise in some of these audit committees is inadequate. The CEO or the chairman of the company has more influence on the audit committee than the audit committee chairman having more influence on these people. So, I mean, in some companies where accounting policies and procedures have to be proactively determined or approved by the audit committees, but generally it's kind of a rubber stamping activity. What I mean by that is companies report what they have done at end of a quarter or end of a half year or end of the year to the audit committee, and they say okay. Because you need to have an audit committee, you need to meet 4 times a year because SEC says so, and then you tick that box off. So we need to move from that to slightly principles based.
So the culture we have is conformance, but a tick in the box, but there's no pride in self-regulation and being principled in the long run?
All these codes started off with self-regulation and didn't see the light of day. When it became mandatory only, people started conforming to it, and conformance, we have at least achieved the first stage of governance, we'll say. Let's now see whether we can progress to the next level. Whether it will happen voluntarily, I have significant doubts. But what central bank did, I mean, for banks, they did a good thing. They made it mandatory, and they issued significant amount of rules. And then they included an audit requirement on those rules as well. So banks were really struggling to meet those criteria set by central bank. So financial services sector to a greater extent has achieved a lot of, these governance principles internally or because of external pressure. that needs to flow down to the rest of the listed companies.
So if a stakeholder, even investor, is looking at a company, what are the common types of fraudulent reporting or misreporting that he or she should be aware of?
Just because I identify these issues doesn't mean all financial statements issued in the country are fraudulent. But there are issues which everybody should be aware of. Revenue recognition. What I mean by revenue recognition is people try to increase the amount of revenue they should record as at a particular year end. So if you're doing 31st March 2011 accounts, the CEO, the board, everybody wants to show better performance. Irrespective of, they don't even think about the next year, because if you increase this year's revenue, next year's revenue is going to be less, but then they think, okay, at that time we can increase that further. Capitalization of expenses. Instead of charging expenses to the profit and loss account and reducing your profits, you tend to capitalize. So lots of these infrastructure companies did that. I mean, globally they found significant errors in I think one of the telecom or one of those operators globally, they found that they overstated their expenses, capitalized expenses to the tune of $4 billion. So it does happen. Misstatement of liabilities or provisions, under reducing your provisions if you like it. If you want to increase your profit, you reduce your provisions. If you want to increase your profits, you reduce the provisions, or vice versa, whichever. So that is another common way. And the last one is taxes, whether it is income taxes or deferred taxes. People try to, I mean, if the profits are not enough, you try to reduce your tax liability with the confidence or aim that you can negotiate with the Inland Revenue. The problem there is again an issue of integrity or governance at the Inland Revenue. If they were strictly adhering to the rules and they did not allow people to vary their tax rules, then people would be more careful. In the US, they are pretty stringent on provision for taxation. If there is a dispute with the Inland Revenue, you still have to make provision in the accounts. If you have any uncertain tax positions, the company can still go and argue with the Inland Revenue, but accounts should reflect the actual provision as taxation, so that there is less room for manipulation. Here, it's the rule of the jungle, I suppose. People can still go back to the department, use the right consultants, and always reduce their taxes.
Now, the result of the audit function ultimately is that audit report. However, the audit reports nowadays somehow seem to be full of technical jargon and a little difficult for the layman investor to understand. It seems more like the audit firms are covering their backs rather than highlighting their findings. What do you think?
Everybody calls it a boilerplate report. I mean, it's like, yeah, it's issued by the Auditing Standards Board. Can we describe stories in that? No, because if you make the audit report 10 pages long, like, I mean, I think the Auditor General on the country also issues long form reports, you will lose the wood for the trees. I mean, people will read it, but they won't understand. Currently, it's concise for a general purpose financial statement. People are not supposed to take investment decisions based on that. They've invested in a company. Does the financial statement overall give a true and fair view? And they should be able to read it and understand. So they read 4 lines and understand it. Now, if we give more than that, which we do give to the board of directors, we give something called a management letter highlighting weaknesses, highlighting non-compliance with accounting standards, non-compliance with various other acts, which do not have a significant impact as at that date on the financial statement. Should we highlight all that on the audit report? Answer is no, because the layman won't understand. If he doesn't understand the 1 page we issue, he's no way going to understand 10 pages, because you can always cover it up with beautiful language. So that's not the answer.
And that concludes our interview with Suren Rajakaria. It's time now for a quick break for some messages from our sponsors. When we come back, we take a closer look at the LMD Nielsen Business Confidence Index with input from an expert. Stay with us.